Good afternoon. Welcome to Gesmer Updegrove's Venture Capital panel this afternoon. My name is John Cohan. I'm a corporate attorney here at Gesmer Updegrove, and I am representing investors and companies, especially in the startup and emerging company world. And I am very happy to have my esteemed panelists here this afternoon. Let's go around the table and talk to them right now.
Hi, thanks for having me. I'm Melissa Withers. I'm the managing partner of RevUp Capital. Been working as a professional investor for about a decade now. Really passionate about diversifying the capital toolkit for early stage investing, and in particular, never miss an opportunity to call out bad behavior on the investor side of the table. So I'm hoping today we can air a little dirty laundry for our founders.
I'm Tom Meyer. I'm an investor, but I've got experience on multiple sides of the venture capital ecosystem. I've been a CEO of venture-backed companies. I've been an investor for a venture fund. I've worked in banking. I've worked in corporate development, buying companies. So I've raised money, invested money, and bought companies and sold companies. So I'm looking forward to our conversation today.
Thanks. I'm Phil Gager with Trinity Capital, deploying venture debt into growth stage companies. In addition to that, as my day job, I also run a small equity fund here in Boston, investing in the first institutionally led rounds of VC-backed companies. This is called Service Provider Capital. So get to see it from both the debt stakeholders as well as the equity stakeholders. So eager to have a great conversation.
Crazy world right now, right? There's a lot going on, a lot of topics, a lot of folks that are out there looking for different investments. In your view, Melissa, let me ask you, what trends or shifts in venture investing should entrepreneurs be on the lookout for at this point?
I think we're starting to say the quiet bits out loud far more often than we used to, and we're having a lot less sweet talk about founder eligibility for fundraising. And I think we're having more candid conversations about the importance of pattern matching and understanding what eligibility means when going out to raise outside capital. And I think we're having more candid conversations about lack of eligibility for certain kinds of funding. So I think as you see the sort of contractions in the end of the market, particularly in the VC side, you're going to see more pressure on entrepreneurs to have to diversify their capital stack earlier in their entrepreneurial journey than they might be imagining. I want to say earlier than they might be imagining because entrepreneurs have always had to be really scrappy about their capital strategy. Right. But I think there was a time when there was more vanilla kind of generic narrative about going out and raising money. And I think now we're having more honest conversations about the challenges of bringing outside capital into your company and what the probability is that you may or may not be able to achieve those milestones.
There's certain things that catch your eye when someone approaches you. For example, they put a plan or they put some sort of paper in front of you that says, this is what I'm trying to accomplish. What are you looking for there? Is something that's jumping out at you?
Well, I think that's an important point. Every investor, institutional or individual, has a pattern that they match to. And so part of the trick for founders is understanding, one, what patterns do they organically match to? What patterns could they match to if they adjusted some things inside their company? And then how all of that gets wrapped into a story, right? A narrative that you go out and try to pattern match with investors. So I think all of us have different theses and we have different patterns that we match. And part of the burden that founders face is you have to kind of figure out not only what patterns interest me, and you got to use your powers of research and back-channeling to figure that out. But I think the bigger challenge is actually figuring out what patterns you match. Like what kind of company do you have and what kind of capital is going to be a sensible part of your capital strategy.
Yeah, I don't like when founders will change what they're doing to suit me, right? I think you're exactly right. Like there's different horses and different courses. Like some investors will invest this profile, some in this profile. If you don't meet that, you don't change. Find a different investor, right? Yeah. They're like, well, what do you want? Like it doesn't really matter. Yeah. You know, like I'll tell you what I want, but like you can't change it, right?
Exactly.
Yeah, I think that's 100% accurate. Tom, what I would say is based upon the pool of capital you're pitching, you may want to adjust your capital strategy. That $500 million fund is not going to write a $500,000 check, right? So I mean, think working backwards from how they need to deploy capital to shape your ask, I think is important.
Right, but just because you're going to pitch the 500, don't say, well, now maybe we should ask for 20 million when you only need a $500,000. Like don't
pitch them at all, right?
Don't pitch them.
Better,
right? Yeah.
Yeah, you know, it's funny. I've represented founders and entrepreneurs in the past that have said, well, we don't really need a lot, but let's ask for that anyway. What they don't seem to understand is they're going to give up some of the control when they do that, right? They obviously, if they're going to ask for more money, there's going to be more equity that's given up for that. And I don't think that, resonates in their head right away. It's like, don't get too much, right?
We're seeing a lot of this now, given the current economic climate in venture fundraising. People raised a ton last time with these big valuations, and they go back to the market and they haven't grown into that, you're in trouble. So yeah, if someone will give me a $20 billion valuation today, I'm going to be in trouble in 2 years if I'm not worth 20 billion or more.
It's only going to go up from there, essentially, right? I get approached a lot on, and we all do, right, on different founders and entrepreneurs, and they've got their heads in 20 different directions, and they want to do 20 different things at the same time. But what's one piece of advice, Melissa, you might give a founder when they're actually looking for financing? What should they really be thinking about at the outset?
I think the hardest part is to understand what kind of company you're building and what kind of capital tracks to that. Because I think if you go to sort of startup school or you go to startup events, you're going to hear like a very narrow story that is probably not applicable to you. And so you have to understand how to navigate that. And there's a big difference between going out and asking individual angels for money, pitching an angel group, going to a regional VC, going to a coastal VC. And I think it's very difficult to educate yourself as a first-time founder. So maybe my advice is, try to find a capital mentor who understands companies in your category and can give you sort of preemptive insight into what your capital strategy might look like over time to sort of just help prepare you for the reality, which is that very few companies just raise successive rounds, linear rounds of equity financing. But if you're a first-time founder and don't have a lot of experience with business building, you might not have exposure to all the different kinds of capital that you should be considering.
If you've got someone that's preparing for a first round, right, what might be the best advice you would give them? What stands out should be the first thing they should be thinking about when they approach an investor to invest in their company or invest in their tech?
Yeah, I think I think it's important to recognize that it's not just the product. Sometimes they'll just come in like, this is the product. I'm like, what's the team? What's the market? What are the bigger dynamics? What's your growth? What's the bigger picture here? And they think if it's like the product will speak for itself. And unfortunately, the world does not beat a path to your door if you have a better mousetrap, right? It's not so easy these days. Maybe in the old days, but not anymore. It's a lot of competition. You got to really have the whole package.
Yeah, you got to build the company around it, right, to be able to present the full picture.
So I think early evidence of product market fit, whether that's some sales, at least minimal conversations with potential strategics or folks who would be purchasers of the product, I think is very important.
It's different things at different stages, right? So it depends on who you're talking to. Or if you're, later stage, we want to see the cash. If you're like just have the idea, then it's really just the team. Maybe not even product market fit.
Yeah.
And then there's that wonderful stage when they're starting to get traction and see it going like, we want to see the product market fit. That's a little bit better.
One size doesn't fit all, basically.
No.
Is the way it goes, right? Another thing is, folks that aren't used to dealing with venture capitalists, founders have lots of conceptions and misconceptions for VCs. What do you think some of those misconceptions might be? And then what's the reality? What should they really be? How should they really be viewing the venture capitalists?
I think sometimes people come in and think that it's just the product. And the VCs will see a good product, they like a good idea, and they'll invest. But it's more than that. It's what's the team, what's the market, where are they going?
I think one really problematic misconception is that VC is a singular thing. Pretty much in our world, anyone that invests into early stage companies is called a venture capitalist. And what there really is in the category of investor and even within the category of venture, just a very diverse spectrum of kinds of capital and investors in that. And I think, again, most founders, when they're first-time founders, don't know enough to understand the nuances of that and the contours of that, and don't know how to make kind of smart decisions about where they're aiming their fundraising strategy. And what you have to demonstrate in a fundraising pitch to, one, funder versus another, right? So if you're going to an angel investor, you're going to have a different set of expectations, and you're going to be really using a different language to articulate the value proposition of that investment than if you're going to go to an institutional venture fund, right?
Right, sure.
And so I think that one problematic misconception is that VC is a singular thing rather than a very, very broad category that's inclusive of investments that really don't even look alike on paper, let alone in practice.
If you know one VC, you know one VC.
Right. That's right.
Every VC is dysfunctional in their own way, just like every family.
Sure.
And there are partnership dynamics that you may not be privy to. There are VCs who want to kick the tires on every deal, but may not have capital to deploy. And then there are VCs who make the claim that they are value added as you build the company, but never deliver on that. Right. The counter is also true. There are great hands-on VCs. So I think the due diligence process runs both ways, for sure. If you take on the wrong capital early, that could sink your company.
I give that advice a lot. It's like it's got to be a two-way street on the diligence, right? It can't just always be unilateral because of a lot of those reasons, right?
Yeah, we have nothing in common aside from being friends. Like how we invest, the kinds of companies we invest into.
Yeah.
There may be some areas of overlap, but functionally we have models that are so different that you wouldn't recognize them as being even cousins on the capital tree.
No
right?
kidding. Okay.
But
right,
here
right.
but here we all are on the same panel,
Right.
sort of being all labeled the same thing. You couldn't have picked three more different representatives from the investment community.
The way I think about it, and I don't think this is my analogy alone, is it's personalized medicine. It's the right deal to the right investment pool at the right time.
Yeah, which brings up sort of the next thought in my head, which is you've had plenty of people that approach you, and you may not be the right fit, or you may not have the right, quote unquote, model for them. Have you been able to say to them, hey, look, you ought to consider alternative sources or alternative ways to fund this? Here's a suggestion. Has that ever come?
Well, yeah. So for starters, venture capital is actually the alternative capital. It funds 1% of all businesses, right? In fact, all the other capital in the market is the normal capital, and venture is actually the alternative. But certainly, I know everyone here has referred a founder to an alternative when they were unable to be a good fit. It's kind of our currency. It's also, we love founders and you want to help them. But I think this notion of alternative funding, which is everything except VC, I think it's wiser from an educational standpoint to flip that, right? So 99% of companies will use everything except like classic institutional VC to grow their companies. But again, when we come into sort of startup environments, we tend to get myopically obsessed with that small category of funding. Yeah. So every company today, whether you're VC funded or not, will have a diversified capital stack. You'd be an idiot to use only equity-based funding or only venture capital to fund your company. That's really for a highly rarefied group of companies that are in a very special category. Every other company should be thinking about all the different ways that people have been building businesses for 100 years. We've only really been using VC since the 1960s. So whether that's revenue, debt, customer-funded R&D, strategic partnerships, non-dilutive funding, that's 99% of the capital every company will use to build their business. And then there's this 1% over here that is special and important and very necessary. But I think considering the 99% to be the alternative is a little bit of a misnomer.
I think, I talked to founders a lot who get all pumped up about the startup and whether they're young or they're pivoting later and they're doing the startup and they're like, and now next thing is venture capital. I'm like, I believe in venture capital. I've done it from all sides, but that's not the best. It's like the last place to go, right? If you can get it other places first, it's better.
Don't have a party after you raise the venture capital. That's when the starting gun goes off. Yeah. That's when you start running. And I've talked to a lot of founders that take that approach and look at their runway every day and understand exactly what they're spending and what milestones they have to hit. It's not time to celebrate until you get to an exit.
I think of venture capital as like rocket fuel. If you've got this rocket that is just zooming and it's super risky, so the bank's not gonna do it, but zooming, and you put this venture capital and you can zoom. But if you're riding a bicycle, which is great, bikes are great, don't pour jet fuel and rocket fuel all over me on the bicycle. That's not going to hurt.
There's just a big difference between $1 million safe note, and a $10 million priced round with preferred stockholders, right? Like that's a huge spectrum, right? And I think the nuance gets really lost, especially for first-time founders.
Yep. And that may be one of the other misconceptions founders have about VCs, is that they think that it's the end-all, be-all, right? But as you say, it's I mean, based on the
yeah, we
statistics,
also
it's not.
conflate all equity as being VC,
Right.
right? So I think some of it comes down to that there's a difference between getting an equity investment on a safe note from an angel investor and going to an institutional VC, right? That's going to do a price round. And so I think part of it too is just compressing everything into this monolith that we call VC and helping founders understand that within that monolith of VC is actually a huge spectrum of capital that has different uses, and you need to learn to evaluate where you fit in that capital continuum.
I think founders get enamored of venture capital, and
Fleece vests.
they'll come to me, and I believe in venture capital as a great funding source, but I'm like, I don't think, if you can avoid it, don't take venture
Understand what you're
Yeah,
getting
sexy.
into, right?
If you can get money from customers, get some, prepayments on deals, customer money, you don't have to pay them back, right? That's better. Or even better, a grant, because they don't have to deal with the customers, which are their own problems. So get some grant money, get some customer money, get some alternative financing, friends and families, delay getting the venture capital if you can get it elsewhere.
And from my seat, deploying venture debt, which we're first on the capital stack, we don't get equity-like returns though. So there is an inflection point where a company has momentum where we can let them arbitrage their valuation today with their valuation in 12 months.
Makes sense. Makes a lot of sense. One thing we brought up is some of the folks that you work with, some of that sort of ancillary, right, that can help to work with founders in addition to yourself. Gesmer happens to be one of those. And I guess I'd like to ask each one of you, what do you think the biggest value that Gesmer brings or can bring to the table in your ventures?
Yeah, I think it's you can get legal help anywhere, but what Gesmer brings to the table is just like we talked about, get the right financing source, get the right legal source. You could get your brother-in-law to write up your docs, but he's not going to know the entrepreneurial ecosystem.
That's good to hear. It's, we try. I mean, what we want to do is not only be legal advisors, but also business advisors, kind of partner up and work hand in hand, whether we're representing the founders or the investors, right?
If we're doing our jobs right, for an early stage company, the legal part really shouldn't be that hard.
True.
Right?
True.
Where I think you need your legal partner to add value is really to layer on both that sort of sensitivity to what the downstream implications might be, right? If to A or B today. But really, I think what Gesmer does is really position yourself in the ecosystem in a way that's really authentic, right? And not driven by fees. Right. Like investing into ecosystem building in a way that is sort of long-term, right? It's not to say that you don't want an ROI on that. Of course you do. Right. But understanding that you need to be patient on how that ROI materializes. And I think for an early stage company, having a legal partner that, can take a bit of a haircut on fees today while still bringing all of that value, like trusting that it'll all work out in the end, that's the kind of worth its weight in gold.
Yeah, we sort of look at it as an investment, right? Just like you guys, what you're investing in, right? We need to invest as well. We try to do that.
100%. And from firsthand experience, Gesmer has been critical in playing sort of a QB role with these companies and helping get the right resources, whether it's consulting CFO, a 409 valuation, nailing that first customer contract so you're set up for success. All that is vital to the success of a company. It's not just the fundraise and the documentations regarding that.
Yeah, so sort of that holistic approach, if you will.
Well, and that's how we met. And so now I can turn to both of these guys when I have a founder who needs something that they have that I might not have. Yeah. And because we've been connected for years, right? Like we can create value that way as well.
Yeah, no doubt. The ecosystem grows.
Yeah.
Like it. So this has been great. So I guess what I want to know from each of you is maybe some words of wisdom that we can leave from each of you that will hopefully resonate with our viewers. Yeah. Melissa, why don't we start with you?
I think I like to tell founders to channel your ancestors sometimes as a balance to the way we talk about building a company, right, in startup environments. Like, remember that for hundreds of years, people have been building companies, delivering value, developing products and services that the world wants and needs, with and without venture capitalists, without anybody, right? So sometimes it's important to remind yourself that the reason why you're building a company isn't to raise money. The reason why you're building a company is because you have a dream and a vision, and you want to make, typically you want to make someone's life better by delivering a product or service, right, that does that. And I know sometimes even I get upside down and, just sort of swimming in all the narrative,
Right.
and you lose touch with that. So I think sometimes say, like, channel your ancestors, and remember that while, it is important to have access to capital to grow your business, there are, like, just don't lose track that winning the fundraising game isn't really winning the business building game, and to allow yourself to have kind of different operating maps and different modes, and just keep that little North Star inside of you about why you're doing what you're doing. And that will really help guide you, to better capital partners, right? Because if you lose that light, if you lose that North Star, then I'm going to take you off course, or the next investor is going to take you off course. And then you're going to end up twisted into knots like a pretzel. And pretzels are hard to untwist without breaking them.
What good is that, right?
Yeah.
Just to piggyback on that, the cliche is ask for advice, get money, ask for money, get advice. But I think it gets at something really important, which is base case is you have to have a viable business with the right product and the right team. But you're in the trenches with this investor for years to come, and they actually have to like you. Right. So establishing that rapport and not hammering so hard on why your company's amazing is vitally important at the early stage fundraise.
I'd say encourage founders to make it happen. Come on in. The water's great. It's a lot of work, but we want to make founders successful. We can help you. Introduce somebody else in the community who can, and let's make an impact in the world. Let's make this world a better place for the next generation.
That's great. That's great. Well, thank you to my venture capitalist panelists here at Gesmer Updegrove. We appreciate you joining us, and we will see you next time. So thank you for watching. Please feel free to follow us on social media. You can like, comment, or subscribe. And please go to our website, gesmer.com.